Corporate finance focuses on how corporations create, manage, and preserve value for shareholders through decisions about investment, financing, and distributions. Its primary objective is to maximize firm value by selecting projects and policies that generate returns above the firm's cost of capital while managing the trade-offs between risk and return. Investment decisions center on capital budgeting, identifying and evaluating long-term projects using techniques like discounted cash flow, DCF, net present value, NPV, and internal rate of return, IRR. These analyses estimate future cash flows, account for risk and timing, and prioritize projects that increase enterprise value. Complementary tools include scenario analysis, real options, and sensitivity testing to handle uncertainty. Financing decisions determine the optimal mix of debt, equity, and internal funds to support investments. Capital structure choices balance the tax benefits and lower cost of debt against bankruptcy risk and financial flexibility. The weighted average cost of capital, WACC, is a key metric used to discount future cash flows and assess how funding choices affect overall value. Working capital management governs short-term assets and liabilities, cash, receivables, inventory, and payables to ensure liquidity and operational efficiency. Effective policies minimize financing costs and service disruptions while supporting growth through cash conversion cycle optimization, credit terms management, and inventory control. Valuation methods translate expected cash flows into a present value for mergers, acquisitions, and investment appraisals. Common approaches include DCF valuation, comparable company multiples, and precedent transactions. Performance metrics such as return on invested capital, ROIC, return on equity, ROE, EBITDA, and economic value added, EV, help track progress toward value creation. Risk management and corporate governance safeguard value by identifying financial, operational, and market risks and deploying hedging, insurance, and internal controls. Governance structures, executive incentives, and transparency address agency problems between managers and shareholders, aligning decisions with long-term shareholder interests. Contemporary corporate finance also incorporates strategic themes: active capital allocation in M&A and divestitures, dividend and share repurchase policies, growing emphasis on ESG factors in investment and financing, and technology-driven analytics for forecasting, treasury, and risk functions. Together, these disciplines provide the framework for disciplined decision-making that sustains corporate growth and resilience.